Sounds true, right? Almost everyone believes it. Financial media pushes it. Investing courses sell it. Your smart friend at the dinner table swears by it. But here's the thing. It's not true. In fact, for most investors, knowing more has led to worse outcomes. More trading, more second-guessing, more mistakes. And that's just one of the lies that the investing world has convinced almost everyone to believe. Today, we're going to tear apart the 5 biggest investing myths, the ones that feel completely logical, but are quietly costing regular people thousands, sometimes hundreds of thousands of dollars over their investing lifetime. Let's find out which ones you believe. Welcome to VestWise, where we explain investing concepts in a simple way. Quick note before we dive in. This video does not contain any financial advice. Everything we cover today is purely educational, so you can make the best decision for yourself. All right, myth number 1. Here's the problem with investing myths. They don't sound like myths. They sound like common sense. They sound like wisdom. They sound like something a smart, experienced person would say. That's exactly what makes them dangerous. Think of it like this. Imagine you're learning to drive, and someone who looks like a driving instructor tells you, with total confidence, that you should always accelerate through a yellow light. It sounds logical, it sounds decisive, and it will eventually get you into a serious accident. Bad investing advice works the same way. It sounds confident, it sounds smart, and followed consistently over decades, it quietly destroys your financial future. So today, we're not just going to identify the myths, we're going to replace each one with what the data actually shows. 5 myths, 5 realities. Let's break it down. Myth number 1. You need to pick the right stocks to build wealth. 148. This is probably the most expensive myth in investing. The idea that building wealth through the stock market requires skill, specifically the skill of picking winning stocks. It's what Wall Street wants you to believe. It's what financial media is built on, and it is, for the vast majority of investors, completely false. Here's the catch. According to S&P's SPIVA report, over a 15-year period, approximately 92% of active fund managers failed to beat their benchmark index. 92%. These are professionals, people with finance degrees, Bloomberg terminals, teams of analysts, and decades of experience. And still, 9 out of 10 of them underperformed a simple index fund that requires zero skill to invest in. Think of it like this. Imagine a cooking competition where 92% of professional chefs with years of training and the best equipment produce a meal that tastes worse than a simple home-cooked recipe that anyone can follow. That's what's happening in the stock market every single year. The reality? You don't need to pick stocks to build wealth. You need to own the market consistently, cheaply, and patiently. A simple, low-cost index fund does exactly that. Myth number 2. You should wait for the right time to invest. 325. Raise your hand if you've ever said or thought, "I'll start investing when the market calms down," or "I'll wait until after the election," or "I'll invest when I have more money saved up." This myth feels like patience. It feels like discipline. But here's the thing. It's actually just fear dressed up in reasonable clothing. Because here's what the data shows. A landmark study by Charles Schwab tracked 5 hypothetical investors who each received $2,000 a year to invest over a 20-year period. One invested immediately every year. One tried to time the market perfectly. One invested on the worst possible day every year. One kept everything in cash. And one spread investments evenly throughout the year. The results? The investor who timed the market perfectly, hitting the absolute lowest point every single year, finished with just slightly more than the investor who invested immediately every time without thinking. And both of them dramatically outperformed the investor who waited, holding cash, looking for the perfect moment that never came. Now here's the key insight. If even perfect market timing barely beats just investing immediately, what does that tell you about trying to time the market? It tells you the cost of waiting is almost always higher than the cost of being wrong about timing. The best time to invest was yesterday. The second best time is today. Myth number 3. Higher risk always means higher returns. 510. This one gets repeated so often, in textbooks, in financial planning offices, in YouTube videos, that most people have accepted it as universal law. More risk equals more reward. But here's the catch. That's not actually what the data shows for individual investors in the real world. Yes, in theory, riskier assets can offer higher returns. That's true, but the key word is can, because higher risk also means higher volatility. And higher volatility does something very specific to real human investors. It triggers emotional decision-making. Think of it like this. Imagine two roller coasters. One is smooth, gradual climbs, gentle turns, boring, but you stay on until the end. The other has extreme drops, sudden twists, and inversions that make your stomach flip. Exciting, but most people get off early. The second roller coaster might theoretically go faster, but if you get off halfway through, you never experience the full ride. That's exactly what happens with high-risk portfolios. According to research from Vanguard, investors in high-volatility portfolios are significantly more likely to sell during downturns, locking in losses permanently, compared to investors in more moderate, diversified portfolios. The reality? The right level of risk is not the highest level you can find. It's the highest level you can stay invested through, without panicking and selling when it gets uncomfortable. Risk tolerance isn't just about math, it's about your own psychology. Myth number 4, you need a lot of money to start investing. This is the myth that keeps more people out of the market than any crash, any scandal, or any economic crisis ever has. I'll start investing when I have enough. And the painful irony? Waiting until you have enough money is precisely what ensures you'll never have enough money. Here's the thing about compound interest. It doesn't care how much you start with. It cares about time. Time is the multiplier. Money is just the input. Let's look at two people. Sarah starts investing $100 a month at age 22. She never increases that amount. She just keeps going, quietly, consistently, for 40 years. At a 7% average annual return, Sarah ends up with approximately $263,000 from $100 a month. From money most people spend on subscriptions, takeout, and things they forget they bought. Now imagine her friend Marcus. Marcus waits until he feels ready, until he's earning more, until things settle down. He starts at 35 with $500 a month. By 65, investing 5 times as much per month, Marcus ends up with approximately $567,000. More than Sarah? Yes. But Marcus invested 5 times the monthly amount and still only ended up with roughly twice the outcome, because he lost 13 years of compounding. The reality? You don't need more money to start. You need more time. And every month you wait, you're spending time you can never get back. Myth number 5. Investing is too complicated for regular people. 835. And finally, the myth that ties all the others together. The belief that investing is a complex, technical field that requires expertise, constant attention, and a level of financial sophistication that most regular people simply don't have. This myth is not an accident. A complicated investing world benefits the people who sell complexity. Active fund managers, trading platforms, financial newsletters, the entire industry that profits from you believing you need their help constantly to manage your money. But here's the thing, the evidence points in the exact opposite direction. The simpler your investment strategy, the better your outcomes tend to be. Think of it like this. Imagine 2 surgeons. One uses the latest, most cutting-edge experimental techniques on every patient, because more advanced always means better, right? The other follows proven, time-tested protocols. Simple, boring, consistent. Study after study shows the second surgeon has better patient outcomes. Not because they're less skilled, because they've removed unnecessary complexity from a process where complexity introduces errors. Investing works exactly the same way. According to a landmark study by Vanguard, a simple 3-fund portfolio, total stock market, international stocks, and bonds, has outperformed the vast majority of complex, actively managed strategies over virtually every long-term time horizon measured. 3 funds, set up in an afternoon, rebalanced once a year, and it beats most of what Wall Street has to offer. The reality? Investing doesn't need to be complicated to be effective. In fact, the simpler it is, the more likely it is to actually work. Let's bring all 5 myths together with one final real-world picture. Imagine 2 investors, both starting at 30 with $10,000 and contributing $300 a month. Investor A believes all 5 myths. He picks his own stocks, spending hours researching. He waits for the right entry points. He takes on maximum risk chasing maximum returns. He stops contributing during downturns, waiting for stability. He constantly adjusts his strategy based on expert recommendations. Investor B ignores all 5 myths. She buys a simple, low-cost index fund. She invests automatically, every month, regardless of conditions. She takes moderate risk aligned with her timeline. She never stops contributing. She checks her portfolio once a year. After 30 years, assuming Investor A earns roughly 5% net due to fees, poor timing, and emotional decisions, and Investor B earns 7.5% net, Investor A ends up with approximately $250,000. Investor B, over $490,000. Same starting amount, same monthly contribution. $240,000 difference, not from skill, not from luck, from simply not believing the lies. So to wrap everything up, the 5 biggest investing lies that everyone believes and the reality behind each one. Myth number 1, you need to pick the right stocks. Reality? Simple index funds beat 92% of professionals over 15 years. Myth number 2, you should wait for the right time. Reality? Time in the market beats timing the market, every time. Myth number 3, higher risk always means higher returns. Reality? The right risk is the one you can stay invested through. Myth number 4, you need a lot of money to start. Reality? You need time, and every month you wait costs you compounding you can never recover. Myth number 5, investing is too complicated for regular people. Reality? The simpler your strategy, the better your outcomes tend to be. Now, does rejecting these myths guarantee you'll build wealth? Not automatically. Your income, your timeline, your discipline, they all matter. But here's what I can tell you. Investors who believe these myths are working against themselves every single month, without even realizing it. And investors who see through them, they stop fighting the current, and they start letting the system work for them. This is not financial advice, just knowledge, so you can make the best decision for yourself. If you found this helpful, hit the like button and consider subscribing. We break down concepts like this every single week in a simple way, so investing stops feeling like something only certain people are allowed to understand. And if you want to go even deeper, check out our video on why 95% of investors never get rich. It pairs perfectly with everything we covered today and goes even further into the habits that separate investors who build wealth from those who just participate. Thanks for watching, and see you very soon. Bye.